Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, June 10th, 2020. The conventional fund business handed back about $21.1 billion to its investors. Second consecutive week they've seen net outflows, but this week, unlike other weeks, it was primarily due to outflows from money market funds. As we've talked about over the last several months, basically we saw about $1.1 trillion come into the money market arena over the last 3 months, and now we're seeing a reversal as people are putting a little bit more risk on their portfolio. In fact, we've seen the NASDAQ hit an all-time high. Not an all-time high for the year, not an all-time high after the coronavirus started anything. An all-time high, closing above 10,000 for the first time. Basically, this week they saw about a 3.86% return. 3.48% return, and it was primarily due to some great news that we heard. Non-farm payrolls came in probably better than anybody had expected. 2.5 million new jobs were actually created in the month of May, and most analysts had anticipated that we'd have a decline. Another 7 million decline. So that was a big boon. Also, we heard that there was concerted efforts by just about everybody in the United States and some other countries to open their economies. And if we look around, we see some states in phase 2 or phase 3 reopenings, and actually restaurants reopenings. So people were actually cheering some of that. And last, we had the FOMC meeting. The Fed met this week. The policy setting group met, and basically after the meeting, they said, even though we saw 2.5 million new jobs come out in month of May, we are not going to, stop the resolve to keep the economy and full employment as one of our primary goals, and we're going to do whatever it takes. And I think that was a big boon for the markets as well. A lot of people thought with the 2.5 million net new jobs that maybe they would not necessarily put on some on the brakes, but maybe put their foot off the gas pedal, and that's certainly not the case. Well, let's see how these news actually panned out as far as flows goes by taking a look at our macro groups and see what's happening in that case. Equity funds handed back about $1.8 billion. So I told you that was almost entirely due to money market funds, and it wasn't entirely. Taxable bond funds took in $9.3 billion. Municipal bond funds took in $2.2 billion. That is the second best week that they've actually seen as far as net inflows going back to 1992. So that's one of the strongest net inflows that we have seen going back to 1992. And of course, as I said, we saw a huge meltdown as far as money markets go, and that's fine because that means people are putting money back to work. $30.8 billion as far as outflows. And you go, well, that doesn't add up. You said there's $21.1 billion in outflows. We're going to see that, in fact, it was ETFs that took up the slack here. But before we get into the ETF group, let's go ahead and take a play-by-play look at equity funds and how that panned out. Basically, as I told you before, equity funds saw about $1.8 billion of money leave their coffers, 7th consecutive week that they've seen outflows. But this week we saw a 1.45% return, and if you look to the right-hand side of the screen, we see 4 consecutive weeks of plus side performance, and those numbers are pretty darn handsome for 1 week returns. Nonetheless, domestic equity funds actually took in money this week. It's kind of a change of pace. We've actually seen non-domestic equity funds take in money for the second week in 3. Again, $333 million came into that group, but they had a 1.46% return. It's the 4th consecutive week they put up plus side returns. Now, on the non-domestic equity side, this is where we saw a little bit of a problem. $2.2 billion in outflow, 10th consecutive week they've seen outflows, and they also had a pretty handsome return of 1.41%. 5th consecutive week that they've actually seen plus side performance, so really kind of outpacing the domestic side, but people are playing it cautious. They're looking for to dip their toes back into the equity arena, and they're just not comfortable yet going out to the international side. How it broke out, though, we saw mid-cap funds taking about $540 million, and even large-cap funds participated. That's been their prior over the last, 50, 60 weeks, basically taking $266 million. So that was a change. On the non-domestic side, we saw international equity funds hand back $1.7 billion, and global equity funds actually saw about $484 million in net redemptions. But as I told you, the story changes a bit when we take a look at equity funds on the ETF side of the arena. Basically, we saw on that, we'll go ahead and switch to that slide here real quick. Basically, we saw on that was a change of pace when we see the 22.2 $2 billion come into the ETF arena on the equity side. And how this really happened, and let me go one step further. That's the largest weekly net inflow since January 24th, 2018. So that was quite a change. But we saw kind of the big traditional funds that we would normally expect to have this happen. SPY, Spider S&P 500, took in about 10.2, and a new entrant here as far as numbers go and flows go. We saw JPM Beta Builder Europe ETF taking about $1.7 billion. On the downside, if we look at the bottom of this graph, we saw the iShares Core S&P 500 lose about $1.7 billion, and we saw the iShares ESG MSCI USA lose about $629 million. So that was a good story, though. I mean, remember I told you that about $21.1 billion left the arena, and now we see that $22 billion went into the ETF. So that's a little bit, I won't say a head scratcher, but we've heard people asking, is this maybe flows due to day trading because we've had such strong returns? I think the market since the trough is up in general about 45 to 48%, which is great. Not enough to win back all the things that we've lost during the latter part of February, March, and part of April. But again, it was that. And so, but we've seen some flows, and I think it was quite a good story. Let's go ahead, though, now and take a look at what the fixed income side of the arena was doing by taking a look at our fixed income macro groups and overall seeing what happened with that one. Basically, again, as I said before, 9th consecutive week they've seen net new money come to the group, $9.3 billion. 5th consecutive week that they've seen pretty strong performance, this time to the tune of 0.86%. I know we've been talking about 5% and 4% and 3%, but a 0.86% return for fixed income security is pretty darn good for a 1 week return. So that's part of the story. Who was the big attractor of assets? Well, corporate investment grade debt funds took in $5.6 billion. Corporate high yield took in about $2.6 billion. And as we might expect, govies did not do all that well. Government mortgage funds lost only about $426 million. And then international global funds lost about $171 million. So a little bit of a change of pace. People continue to look for yield. Again, we've had corporate investment grade and corporate high yield over the last couple of weeks actually being the benefactor of people's changes. Well, let's go ahead and see how that panned out as far as ETFs go. On the ETF side of the arena, basically what we saw was that they took in, to the lesser amount, $1.8 billion, but it's the 11th consecutive week they've seen that new money coming into that group. How it broke out, though, was we saw the iShares iBox dollar high yield corporate bond ETF taking about $2.2 billion, and then we also saw the iShare iBox dollar investment grade corporate ETF taking about $1.1 billion, where the bottom side, remember I told you it's kind of a risk off. Basically, we saw the 3-month Treasury bill ETF lose about 1 to 3 month, lose about $902 million, and we saw the iShares short Treasury bond ETF lose about $887 million. So again, risk off play that we've seen on both the equity side and on the fixed income side was certainly present, and people are again putting money back to work into more risky assets. Let's go ahead and take a look, though, now at the municipal bond fund side of the arena and see how that basically paid out. On the muni bond fund side, we saw net inflows of $223 million, $2.23 billion, and they had a very handsome return of 0.67% return. Now, remember I told you the $2.2 billion inflows was the second largest on record going all the way back to 1992. It's the 5th consecutive week they've seen net inflows, so that is a change of pace, and it's the 6th consecutive week that they've seen plus side performance, and 0.67 seems to be very much in line with what we've seen in the prior 4 or 5 weeks. The big winners, though, this week as far as drawing net new money, short muni debt funds took in about $570 million, and general insured municipal debt funds took in about $556 million. Now, again, this is quite a change. What we did see, though, is the municipal ETF actually take a pretty big jump as well, taking about $529 million. And in the past, we've been seeing the hundreds and $200 million a week. So this was something to help push it over as well. So even if we take a look at conventional funds and ETFs together, it was the second largest week on record, going again all the way back to 1992. Let's go ahead and take a look at our last category, and that's money market funds. And money market funds basically saw big outflows, and as I told you, it's the second consecutive week that we've seen big outflows, and this time to the tune of $30.8 billion. So it's the fourth consecutive week that they've suffered outflows. Last week it was about $30.5 billion, but this was one of the bigger ones that we've seen in a little while. Again, there's been larger outflows in prior time periods, but again, for the most recent time period, that is quite a change of pace. But how that broke out, taxable money market funds saw about $30.2 billion in outflows, and if we break that down even further, we see institutional money market funds handed back about $26.4 billion, and retail money market funds handing back about $3.8 billion, and tax-exempt money market funds saw about $572 million in net outflows. Well, that basically does it for us again this week. But obviously, on Thursday of this week, today is Friday, when we're recording this particular segment, basically we saw about a 7% decline, between a 5 and 7% decline in the major indices, the NASDAQ, the Dow, and the like. But we saw a nice 2-3% comeback here on Friday, so we'll have to keep an eye on what's happening. But investors are obviously concerned by what they're reading in the Wall Street Journal and other journals out there that are basically talking about an increased infection rate and hospitalization rate from the coronavirus, from COVID-19, and I think that's going to keep people basically in line and taking a look at it. So we had a huge meltdown again on Thursday, and we had kind of a, I guess you might call it a melt up on Friday. So we'll have to see how that carries over and what's actually reported during the week as far as the infection rates, the death rates, and the like go. A lot of people said the increased infection rates are only due to increased testing, and other people said no, it's actually new cases and it has nothing to do with new testing. So again, we'll have to see how the pundits kind of slice and dice this and take a look at how it's really impacting the economy, how it's impacting our public, and how it's impacting our health. Well, if I didn't do a deep enough dive for you, you can go to www.lipperusfundflows.com, or you could go and come back next week and talk and watch one of our analysts give the highlights for the week as well. Well, thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.